All right, let's just picture this for a second. You're in charge of a country's finances, right in the middle of a global pandemic. Money is tight. So what's the absolute last thing you'd think of doing? How about a massive tax cut for corporations? Well, that is exactly what the Philippines did with its Create law. And today, we're going to break down why. Okay, so let's just start with the big question right off the bat. In the middle of the COVID-19 pandemic, with businesses shutting down and the economy basically grinding to a halt, why on earth would a government decide to collect less tax from companies? It just sounds completely backwards, doesn't it? Well, the thinking behind it is kind of like trying to get a car with a dead battery to start. You don't take more power out of it. You need to give it a jump. The goal here was to give businesses a little extra juice, some extra cash, to help them survive the crisis and, hopefully, get the economic engine running again. And that big economic jumpstart was officially called the CREATE Law. Now, that's an acronym, of course. It stands for the Corporate Recovery and Tax Incentives for Enterprises Act. And make no mistake, this was rolled out in March of 2021 as a direct answer to the economic damage from the pandemic. So to really get how this law actually works, first you got to understand how the Philippines classifies its companies, because for tax purposes, they're not all treated the same. They're basically sorted into three main buckets. And this table lays it all out pretty clearly. It really just boils down to two things: where the company was legally created and whether it actually operates in the Philippines. But the real kicker, the most important detail here, is in that last column. See that? Only one type, the domestic corporations, get taxed on their worldwide income. That is a huge difference. First up, we've got domestic corporations. These are your homegrown companies, created right under Philippine law. You know, the big names you see everywhere, like Jollibee or BDO. And the key thing here is, it doesn't matter if Jollibee earns money in Manila or in Los Angeles. All of it, their entire global income, is taxable back home in the Philippines. Then you have your resident foreign corporations. Think about huge global brands that have set up shop in the Philippines, like Toyota or McDonald's. They were created under foreign laws, but they have branches and offices doing business locally. And that's the crucial part. The Philippines only taxes the money they make inside the country. Whatever Toyota makes in Japan is their own business. And finally, the third bucket is non-resident foreign corporations. Now, these are foreign companies that don't have a physical office or branch in the Philippines. So you might be asking, well, how do they make any money there? Usually it's through passive income. A good example is a foreign bank giving a loan to a Filipino company. The interest that bank earns is considered Philippine-sourced income. Okay, so now we know who the players are. Let's get to the heart of the CREATE law and look at how it actually changes what companies have to pay. This is where the numbers come in. And here it is, the main event. Before CREATE, the regular corporate income tax rate was a pretty hefty 30%. The new law dropped that down to 25%. Now, a 5% drop might not sound like a lot, but for a large company, that is a massive, massive saving. But hey, everyone knew that the pandemic was hitting the smallest businesses the hardest. You know, the mom and pop shops, the startups, all those MSMEs, or micro, small, and medium enterprises. A general tax cut is nice, but these guys needed an even bigger break just to survive. So the CREATE law did something really important. It created a special, lower tax rate just for these smaller domestic companies. Their rate wasn't just dropped to 25%, it was slashed all the way down to this number, just 20%. Now, of course, you can't just claim this super low rate. There are a couple of conditions. To get that 20% tax rate, a company has to check two boxes. First, its net taxable income for the year has to be 5 million pesos or less. And second, its total assets have to be under 100 million pesos. And that doesn't even count the land their building is on. You have to meet both of those criteria to qualify. All right, so we've got the rates down, 25% for most companies, and a special 20% for the smaller ones. Now, let's do a quick run-through of how they actually calculate the final tax bill. You know, the basic math is actually pretty straightforward. It works like this. You start with your gross income, which is all the money your business brought in. Then you subtract your allowable deductions. You know, things like salaries, rent, and supplies. Whatever is left over, that's your taxable income. And that's the number that gets multiplied by either 25% or 20%. Simple as that. Now, when it comes to those deductions, businesses actually get a choice. They can go the itemized route, which means they track every single legitimate business expense and have all the receipts to prove it. Or, for something way simpler, they can choose the optional standard deduction, or OSD. That's just a flat 40% deduction off their gross income, no need to show any receipts. It's really a choice between being super precise or being super simple. Okay, and here's one last really important little detail. Remember those non-resident foreign corporations we talked about? The ones with no physical office in the Philippines? Well, since they don't have local operations, they don't have local expenses to deduct. So the rule for them is different. They get taxed on their total gross income, their total revenue, not on their profit. So, we've looked at the different kinds of companies, we've seen the new tax rates, and we've walked through how it's all calculated. So what's the big picture here? What's the bottom line on the CREATE law? The bottom line is really this. The CREATE law was a very specific tool designed to do one thing: lower the tax bill for businesses. The idea was to leave more cash in their bank accounts, especially for the smaller guys. And the hope was that they'd use that money to stay open, to reinvest, to hire people back, and to basically help get the entire economy back on its feet. And that leaves us with the million-dollar question, doesn't it? The CREATE law was a huge gamble, a bet that giving companies a tax break would be the spark that reignites the whole economy. But will that bet actually pay off? Is this the key to a strong post-pandemic recovery? Well, the answer to that is still being written, and it's going to shape the Philippine economy for a long, long time.